Hey everybody, it's Pete Carmesino here at Chaikin Analytics. This is the halftime show here on StockCharts TV. Each and every week, we kind of go over the markets, what's going on, and we look at a lot of different things. And I'm going to be talking about bonds today because these things are hitting and approaching some targets I've been talking about for roughly 20 months or so. So the point is that I'm not here, I'm not happy rates are going higher, but I'm saying to you that the trend was there, it's happening, and you have to respect it, right? So one of the things we'll look at today is TLT. That's really the 20-year U.S. Treasury ETF. And a lot of people talk about it. It's quoted a lot of times during the day because, look, it's a good proxy for sort of longer end. But that is actually approaching new lows here in recent times. And my target, I should say, has been $75 to $80. That's the high of many, many moons ago. So we'll look at that chart, just squeeze it backwards so we can see what it's looking like and what's happening there. And again, I take no pleasure in the fact that bonds are getting smoked and plummeting. But the point is, I do take some pride in the fact that we've been calling out this trend. I've been calling this trend out for a long time now. And I got my chops in fixed income. That's where I started in this business. And so it's not really unlike a lot of folks to not follow fixed income. You should be anyway. It's dictating a lot of things, dictating oil, it's dictating the dollar, dictating the economy, potentially the unemployment rate. It does a lot of things. A lot of people kind of shrug their shoulders and just move on, but you've got to watch that because it's going to dictate trends in stocks. And so take advantage of it. You've got the charting system. Obviously, if you're watching this, hopefully you're using the stock chart system. The ACP platform is tremendous. You got an awesome opportunity to put all kinds of indicators and lines and channels and all those good things that we do here on your chart and help guide you through these markets. So we'll look at that. We're also going to look at the dollar, of course. We're going to look at oil. I'm going to check out the Nasdaq and the S&P again in that channel that they've been sort of adhering to, and the Nasdaq is maybe teetering on breaking it if it hasn't already. Technically, it probably did, but we like to give it a day or two here just to make sure that we didn't miss something or the fact that it could turn around, but you don't know. But that's where it's at. And the next leg down is a little further. We're going to look at some energy situations like coal stocks. That's right. I said coal, COAL, coal stocks. That's right. Coal stocks. I'll say it again. Amazingly, all of these names are up today. We're going to look at some nuclear names. Look at a nuclear ETF and a couple stocks inside there that are packing a little bit of a punch here today. So I'm going to look at that. I'm going to look at the sector ranking. I think you'll be surprised what happened in the past week. I mean, most of the sectors were down. Actually, all the sectors were down last week, but the top three are a little surprising. And then just some other breakdowns that continue. Home builders, called them out last week. All of them are turning trend now on the downside. A new one hit the list, and we'll look at that one today, along with a couple other consumer names that are also kind of teetering on the brink of a negative relative strength change. So all of that is here in the halftime show. Let's dive in, check these charts out. All right, first chart I'm going to look at here is the U.S. 10-year. I'm just going to start there. We'll jump into TLT, oil, dollar, and all that stuff too. But I'm on the CNBC chart because it's updated here as of 2:06 p.m. here, up, just less than 9 basis points, or I should say just more than nine basis points, but at 4.53%. Now, I had a target on this of somewhere between 4.5 to 5. Then obviously it's on that trajectory right now. Don't know if it's going to attain 5. If it does, it's probably not the greatest thing that we could see here. So that obviously concerns me. But you can see this trajectory here is starting to turn. We've been talking about this for a long time. This is a real long-term chart. The reason I did this was to look for some areas of maybe support and resistance, and probably kind of where we are right now seems to be an area that it could teeter above and below a little bit. But a lot of people are talking about this being the normal rate. It's not really the normal rate. It's the old normal rate. The new normal was way well below that, and now it's ratcheting up at a terrible pace. Part of the problem that we're having in the bond market is because of rates moving so fast. And that's because bond prices are falling. There's the chart here on the ACP platform. You can see we closed at around 444. on Friday, and it was down a little bit, but now it's up, right? It's up. So it's over the 4.5% again. And so it's inside this box that we had as a target. Multiple targets were hit pretty rapidly when we first started doing this, all the way back from December of 2021. And since then, really, I've been kind of patiently waiting. And look, this thing never really broke down. If you can look at that trend, it sort of overlapped from a 55 EMA to a 200-day level here and kind of just stayed sideways, and then the trend continued. So this is what you call a base and a continuation, and that's what's happening. It's 4.5 to 5%. You can see the TLT down here trading much lower here. This is a daily chart. We'll look at that chart specifically right now. All right, here's the TLT chart. I look at this. This is a weekly chart, and I'm squeezing it into where I built this target based on what we saw back, oh gosh, who knows, all the way back in December 2008 when yields have spiked because bonds obviously were falling. And there you have, I think, an interesting target. And why? Well, because not only was it a peak and resistance, which broke and then became support, it's most likely going to do the opposite, right? It's going to obviously come down and most likely test it. I can't say, I wish I knew for sure, but between 75 and 80 is a range. Nothing is exact. I wish it was, but my major point here is that a lot of this is predicated on obviously what's happening out there in the economy. And one of the things is the unemployment rate. And again, looking at what's happened in the past, when you start to see yields get cut, that's when unemployment starts to rise. We have not seen that yet. We're still at around 3.8. We'll get some updated numbers next week. But my suggestion to you is that understand the relationship between that and rates, because I do think, again, I think we're months away from this. I don't know for sure, but I do think eventually the Fed will have to cut rates. But again, this is months away. It looks like the damage is not done here on the downside. Unfortunately, I think we could see some lower levels in TLT. All right, here's my dollar chart. We've been using these kind of, again, unorthodox channels where they're kind of intertwined a little bit. I got an upside move here on a 50 over 200 day. Not something you typically track on the dollar, but look, it's there and it is what it is. It's sort of a trend following, nomenclature that you can see when moving averages cross. There's obviously a trend that's either already developed or just continuation, and this is more validation. Obviously, the trend started all the way down here at 99, and here it is approaching the 106 level, if not already above there today. And again, these are end-of-day charts, so you want to look at this at the end of the day. If you can chart this or duplicate my chart to see where it ended up. But I know the dollar's up today because there's another instrument you can follow to look at the dollar, and that is symbol UUP, which I'll pull up right now, right here on the video. Save my chart and keep going. And it's up a little bit today. Again, almost 0.5%. That's actually more than a little bit. And you can see where we're at levels where we were roughly around the same time last year. For goodness sake, almost to the day. Let me see there. Let's see. This is a daily chart. That was 922 last year. It's 925. We'll call it a year. So we're kind of right around the same level that we were last year. I don't know if we're going to see this spike or not, but pay attention to UUP. It's obviously a proxy for the dollar, and it helps you kind of track that on a daily basis, and even use this to potentially hedge if you want to. It gets a little sophisticated, but at least you can watch it and track it a little bit. And, we can't go a week without talking about oil because this has just been the story. And a lot of this is predicated on the dollar, obviously predicated on rates. Everything is moving in order, folks. I said this, I think I coined this phrase. I don't know, but I'm going to start putting it on social media so I can say I coined it. And the phrase is, dominoes don't fall out of order, okay? Things happen in order, and that's what's happening here. You're seeing rates move. Obviously, bond prices are accelerating the rates higher because they are falling, and that's how that all works. It's all connected. Don't think something happens in a vacuum because it doesn't. It's affecting everything here. And here's USO, obviously teetering on this $80 level. And again, it's not a one-for-one proxy to the WTIC chart that we typically look at, and I will look at right now, just to show you where we were. That was over 90 when it closed on Friday. Let's take a look at that chart. This is one of my favorite charts because we're talking about that White House buy zone, which became amazing support. When it got above 90, you started to see some moves lower, and obviously it's peaking its head up above 90 again. Now, look, If it gets into this 93, 94 range, you've got, $100 on the table. I think my target's somewhere between the 120 to 130 level. I'd hate to be right on that, but that's kind of what I think we might see here. That would be testing some highs, but not all-time highs. So if you go back and look at, let's say even a weekly might get me there. Yeah. Back to 2008, right? Don't forget, we traded as high as 145. So if we get into this range, obviously that's very rich. It gets a little panicky up there. Here, it lasted for quite some time, for several years in a row before it fell off. And here, just for a few weeks, and then it turned tail. But certainly approaching it again, I would just be very wary of what we see here in oil. Just watch it closely because, look, it's going to be something. And obviously, when all these prices move higher, we were talking about coal stocks, they're starting to move up as well, obviously because it's maybe less expensive than burning oil. Now, so much for climate change and fossil fuels going away. That's not going to happen, not at these levels of pricing. Starting to like this chart too, folks. This is my Nasdaq chart here, the Nasdaq 100 NDX. It's a channel we built here, tested a few times on the way up. It's testing it again. I said it breached. You can squint and say, well, maybe it didn't exactly. Technically it did, and it is opening below there today and trying to rally back. And I don't know what's going to happen here, but I do know it's about an 8.5% pullback, and it's matching kind of what we were at before. I thought it would time it perfectly. It pretty much got close, but didn't hold. Now, the next issue here would be a gap fill all the way down that we said is around a 14%-ish move down below into that next gap fill, which could coincide with the 200-day. We'll see. I might have to extend this if we go past this level of October 18th. That's mid-October that I drew this little gap to. So I'll push it all the way out, and we'll see if it hits and see what happens there. We'll use it as a future barometer, because if it does get there and go through, it'll become resistance. If it holds, it stays support. Okay, here's the S&P. Same chart, same methodology here. We had it here on the NASDAQ, a couple times tested. You can see all these pullbacks that we had. They were orderly. 10, this was last year around this time in September. So we know seasonality could come into play. A lot of people talking about that. We get it. Hopefully it does again. And if it does, it looks like it's going to test the channel. If it tests the channel, it could be that pullback of, again, just 8% or so. Interestingly enough, it's coincided with the 200-day and previous round numbers of around 4,200 or so, maybe a little bit higher. Even if it gets through there and tests, it should be okay. My old number was 4,172. I'm going to keep it on there because apparently that was an area of resistance that broke through. Could be an area of support right now. However, that would also be around the 200-day, as I mentioned, but we do have a gap fill below that, which is around 13.5%. That's when it gets a little squirrely, and potentially we break that 200-day like we did a few times here, and people get a little worried. But again, right now we're not there, and the channel is still in order. And again, dominoes have to fall in order. We got to see this break, then that level, and then this level. Things have to happen in order. Now, of course, it can capitulate. Let's hope it doesn't, but no one's really expecting that. We can't really plan for that. So this is what we see right now. So this is what I'm sticking with. All right, let's do a little sector review here. This is the 1 week. I'm sorting this by column. Right? I can sort it by monthly or 3 months, 6 months, sorting it by the previous week. And the top 3 level sectors were the defensive sector. And I say top 3, they were down the least. 2.65 on consumer staples, 2.5 roughly on utilities, and about 1.5 on healthcare. So they're the top performing sectors. That means people are moving into a defensive posture, rightfully so, based on what's happening here in the markets. And one of the ones that obviously that's just below that are tech stocks, which are information tech, XLK and XLC, the communication ones. Obviously, they weren't the worst, which is ironic. The worst one was discretionary now. You can call that a bit of a tech fund because the 2 top names in here, which are, gosh, almost 50%, a little less than that, maybe 45 and change. Amazon and Tesla, both bullish, but really making up a heavy portion of XLY. It's a tough sector fund to kind of get behind because of these weightings are just so out of whack. I think something needs to be done there. All right, we talked about coal stocks. I have a list of coal stocks. I've been following coal stocks. I've been following them for quite some time. They are a proxy. Obviously, when energy prices ramp up, they move higher. You can see this is a coal name, ARLP, Alliance Resource. Obviously, it's in that produces and markets coal primarily to utilities in the United States. And so you've had a relative strength change way back here. This is, again, the end of 2020, okay? And then obviously you're seeing this again after a breakdown. And when you see that, you're like, it's pretty amazing that it can happen at these higher levels. Stock's only 22. I don't think it's a big market cap. It's 2.7 billion. That's not small. A heck of a yield there, but not buying it for the yield. Just be careful. Again, it could be a little bit more volatile, but it is breaking out. CEIX, Consol Energy, another name in that group, which was already breaking out since June or so, tested this area and moved higher. Again, that's about $100 stock. You got ARCH, Metals and Mining, HCCC, Warrior Met Coal, another one changing trend. Met Coal, METC, which is Cameco Resources. Again, nice breakout here. Interesting, not above on the relative strength, but the industry is still considered weak. You got BTU and you got Tech, Metals and Mining Resources. Really, that's the worst of the group, and it's also rated very bearish. So these names here, METC and the rest on the up, look pretty interesting from a coal standpoint. All right, we can't talk about coal without talking about the nuclear stocks here. We were talking about this. This is uranium. This is the ETF. Through Global X. It's a very interesting ETF. Now, I only have the U.S. stocks. There's many more stocks in here that are global, but I only have the U.S. listed in here because that's how we follow them. And obviously, a lot of this is predicated on the technical move in the ETF. So it's rated very bullish based off the technicals, and you know it because of that relative strength here at $21.82, $22, and it broke out all the way up to 28 and really moving high today, up 4%. And there are some names in here that are interesting. Now, just got to be careful with these. A couple of bigger names here like LEU, Centrus Energy. Not a heavy market cap, though. It's under 1 billion, so it's really a small cap. And then you've got Cameco Corp, a lot of people have been following. Much bigger company in the uranium producing segment of this market, and a bunch of little ones here. So just be careful when you see these. They don't all look fantastic. Some are in a very bad downtrend. Some are firming up, like Quad U here, UUUU, Energy Fuels. Let's see what they sell uranium, vanadium and other rare earth elements. And so market size just over $1 billion, small cap stocks names here. So a lot of people are talking about this obviously as an alternative energy. It certainly is. Tennessee Valley Authority has been running nuclear since the 70s pretty successfully. So hopefully we can maybe turn some resources into that area to help us here with some energy prices. All right, last on the list here is breakdown. So we're looking at some names. Again, I said some retail names are kind of breaking down here. Here's Boot Barn Holdings, specialty retail. I'm going to assume they sell boots. But we've got this breaking down below that area of support of $88, $89, below the long-term trend. Again, weak trend, weak industry, breaking down here, bad money flow. Again, you got to be careful when you start to see these changes. Some ones that really caught my eye, we talked about this a week ago. Homebuilders, KBH now is on my list. It wasn't last week, but it's a weak stock and a weak trend, and certainly has broken down here on the relative strength. And concerned about this price here. This to me seems like resistance, 46 to 49, that area, and this would certainly be support right around where it kind of stopped going down around that 45. Also at the lower end of the band. Just be careful here. Shopify is another one. We talked about this earlier here in the video. I said some consumer names. Obviously, it's a tech name, but it certainly serves consumers as well. Breaking down ELF, Elf Beauty, personal care products breaking down as well, and Roku, which is another sort of consumer name, also breaking down. There's one here which surprised me, ALC, which is Alcon, healthcare equipment, really got toppy, couldn't get above there. Heavy money flow. When you see heavy money flow where it can't get above a new high, when you see negative money flow there, that's one of our interesting indicators we notice over the years. Just pay attention to that. Below this number gets a little worse, folks, maybe the 65 to 60 level. Okay, there you have it, folks. That's this week's halftime show. Again, I'm Pete Carmesino here at Chaikin Analytics. Thanks for tuning in. We'll be back next week with another video. Take care.